Welcome to TheoTrade. This is Don Kaufman, June 18th, 2021. Just over 20 minutes to go to the cash close here on this Friday afternoon. It's also, of course, quadruple witching. A little bit of volatility to the overall marketplace here. And we're going to try to answer the question for you. Is the Goldilocks marketplace, is it dead? Let's get to that and much more here on this weekend update. First and foremost, let's look back at some of the volatility from this past week of trade and what has amounted to, well, bifurcation turned into correlation. We're going to cover that and much more, starting with the fact that here we are again, as I said, just over 20 minutes ago to the cash close, the SPUs, the S&P futures, which have now rolled forward this week. That roll is over and done with. They're down about 41 handles. Let's not really get too crazy about this or put the cart before the horse. I mean, net, what do you got? It is less than right now a 1% move down in terms of the S&Ps. I mean, the Nasdaq's actually going to finish the week considerably higher. So there's all this discussion, of course, of the marketplace and the volatility. Yeah, the volatility picked up, and we're going to look at that. And yes, that volatility was triggered by the Fed. Nevertheless, the extremes have by no means been hit. And that's what we're going to explore because, well, quite simply put, there's very likely some more volatility coming. Now, with that being said, let's kind of kick it off here with a little bit of this market update. As I was saying, the Fed has kind of triggered some of the market volatility. But people, it's not actually exactly what you think. I mean, the Fed came out on Wednesday, and we're actually going to look back here at a 30-day 1-hour chart in terms of the S&Ps. So the Fed comes out on Wednesday with well, the FOMC, update, and Jerome Powell does a little dance. The marketplace, mild sell side activity. Again, the VIX kind of picked its head up off the floor. Today, however, was very unexpected. So we had Fed speak this morning, and that Fed speak actually occurred pretty much at 5 a.m. Pacific time. And that was actually one of the voting members for the 2022 Fed, and that is Bullard. He came out and actually said, well, the Fed got caught off guard a little bit, maybe a little surprised about some of the inflation. There it was, people. That actually sparked unequivocally some of the sell side activity. On top of that, he went against the dot plot and actually mentioned, simply put, that the Fed, he could actually see a rate increase as late as 2022, which again stands in contrast to the dot plot quite considerably. Anyway, that sparked a little bit of volatility in today's session. Nevertheless, I like to put this in some perspective, and to put things in perspective, you use, auto expected moves. And for auto expected moves, I'm going to go ahead and do that. And I'm going to start here specific inside of the Nasdaq. And the reason I wanted to talk a little bit about this is there's this wild bifurcation again going on in the marketplace. We've been talking about it kind of incessantly on some of these evening videos and during some of the chat room sessions. This breaks down to the fact that the Nasdaq continued to rally. In fact, the Nasdaq just got shy of clipping the upside expected move in yesterday's trade. Now, yeah, the Nasdaq is down today, but it's down to the tune of about 0.5%. As I said, though, a moment ago, the Nasdaq is still going to finish the week, considerably stronger. Now, time out. Before I go any further, I already want to foreshadow something here. If we're going to have continued volatility, and I'm going to show you here in just a few minutes that we very likely are going to see continued volatility, it is the Nasdaq, that at this point in time clearly stands the most to lose. So you have to look at this from a sector to sector standpoint. And again, while we're doing the market update here and kind of looking back a little bit, I also, again, want to kind of project forward. Because if you take a look at the Nasdaq, again, it is completely and totally unscathed. I mean, the Nasdaq is it even a day removed from the all-time high? Absolutely not. It literally hit it this morning. The Nasdaq is threatening coming back down to the 14,000 level and literally bounced off of it. Nevertheless, I want to reiterate, if you believe that there's going to be continued sell-side activity to the broader marketplace, it's the Nasdaq that you actually want to be your kind of key focus. Why? We'll take a look at some of the other sectors out there. If we bring up the financials, right? I think that this pretty much states it. Financials have been crushed. The best way to kind of delineate financials getting crushed, again, is to apply auto expected moves. And these auto expected moves, what do we have here? Well, outside the expected move last week, this week, you're looking at a full-blown like 3 sigma move. I mean, they really did. They got absolutely crushed. In fact, another way to actually kind of differentiate would be to actually look at the financials on a year-to-date basis. The financials were up literally 2 weeks ago, okay, and that's the XLF, about 32%. They've actually given back their gains quite considerably. They're up about 21%. But, let's get really specific. You want to get stock specific, look at something like Citi, which was literally up some 33%. It was following pretty much lockstep with the XLF. Citi now has it's threatening the gains on the entire year. It's only up now 12.5% on a year-to-date basis. Okay, so push aside the financials for just a second. What occurred in the financials? Well, it's quite simply the bonds. Okay, so I'm going to jump ahead over here and say the bond bid. The bond bid has really caused a tremendous amount of confusion. But the bottom line with the bonds being bid, okay, is that interest rates are going to go considerably lower. And this is where everybody is starting to scratch their heads and go, oh, what gives? Wait a second. The Fed is actually talking about doing what? The Fed's actually talking and discussing about eventually raising rates. The Fed may even have to turn around and raise rates earlier than they anticipated. Yes, but the rates that are discussed by the Fed are predominantly Fed fund futures, which are really like overnight, lending rates. That has implications to the longer duration. When we start looking at something like TNX, though, come on, this is the 10-year. This is saying something very, very different. And this is why I actually titled this weekend's update, Is the Goldilocks Marketplace Dead? If the reflation trade is dead, Goldilocks is also dead. If you're not familiar with the terminology of the Goldilocks marketplace, let's look at overall what's going on. Again, we can point the finger to Goldilocks marketplace really relates to the Fed, and the Fed is an incredibly accommodative stance, okay? Their accommodative stance is going to unequivocally come to an end. Well, they haven't exactly said why, when, or why for that matter, but they haven't exactly said when that's coming to an end. Again, the dot plot pointed to 2023, but again, one of the Fed members came out this morning, said 2022, as we said a little bit earlier. The bottom line with all of this, okay, and in the Goldilocks marketplace is accommodative stance is not going to get more accommodative, meaning that we've seen it, baby. It's as good as it gets. And that's a phrase I've been using all the time over here, like Goldilocks, it's dead. Okay. Oh, it's very much dead. So that has to do with some of the monetary policy. Like the Fed is not going to go out there and extend themselves unless the economy really started to backslide. But at this point in time, they heated that economy up. They need it to actually cool down a little bit. Otherwise, we got an inflation problem. Don't worry. It's just transitory. Okay. By the way, I've overblown that term. I can't stand it anymore. It's transitory. Listen, the Fed can call it anything they want, because if the Fed believes that the inflation is transitory, if it's not, guess what? They're still going to be right. Want to know why? They'll just jam the interest rates higher. Okay, squash that inflation like a bug, and you along with it. But the Goldilocks marketplace, again, is dead. And I want you to think about this. The accommodative stance from the Fed. Now we're basically just waiting for the Fed to say, hey, we're going to do some tapering in the bonds, right? Eventually, that's going to happen, maybe the end of this year. Then we're just going to be waiting for the Fed to say, I'm going to raise rates, right? So where's the accommodative stance? There is nothing else coming. What about stimulus? Okay, let's talk about, from monetary policy into fiscal policy, all right? And maybe, what's going to pass through Congress. Come on, you're not looking at more stimulus. In fact, there's many states that are actually going to lose some of the unemployment benefits. We can go on and on. It's as good as it gets. Right? And that's over. So Goldilocks marketplace, in my opinion, is unequivocally dead at this point, and the reflation trade is coming in. So the bonds are not necessarily reacting like you thought they would. They're going to buy the bonds. They're going to actually buy the bonds. Now, buying bonds is shoving rates down. What loves that? What hates it? We've talked about this extensively in recent weekend updates. If you take a look at bonds flying high, and then again, that would take rates, okay, lower. So if rates are actually going to head lower, it's going to hurt initially, okay, again, the financials. What goes with the financials? And we've talked about that extensively as well. The energy sector lately has been tracking with the financials almost like a 1-for-1. So if you ever discuss some of the financials, I think it is remiss to not actually bring up the energy sector as well. Now, the energy sector, has it been faring as poorly as the financials? Absolutely not. But take a look at auto expected moves in this particular front. You better believe it definitely had some sell side activity, and it is going to end up way outside the edge of the expected move. So you've got energy, you've got financials, okay, and you've been battling, just battling, if you will, against the tech sector. And the tech sector out there, and the Nasdaq as a whole, again, it's down like 0.6%. Be still my heart. But here's some of the key points with this. So what we're actually doing over here is we're going over to Index Watch. I'm actually going to pull up the S&P 100. We're going to look at the advanced decline line. Correlation coefficient. We're home, baby. All right. Correlation. The big question mark on this one, is this going to be consistent? Because if correlation is now going to grip hold, and you can see it grip and hold right now. There's nowhere to run to, nowhere to hide. Everybody always points out, I can go to NVIDIA. Yeah, until you can't. But the point of me bringing up this correlation, okay, this is the biggest question mark in the marketplace. Because if this correlation holds into early next week, they're going to crush the Nasdaq. They're going to come after the Nasdaq in a big way. It's not going to matter what you think, what you know. The bifurcation could be gone. And that's one of the things, though, that I cannot answer based on looking at this particular tape. So last but not least in this market update, right, I want to bring up the dollar. And then we're actually going to be very, very forward looking. So look at the dollar, all right? The dollar, again, I look at this as a likely fear trade. So the dollar to me is like kind of like the new VIX. When the world gets scared, right, where do they go? Do they go to the bonds? No, okay? We don't need no stinking bonds, although, yes, the bonds are being bought over here, but it's for a completely different reason. But it looks like the world right now wants to buy the dollar. And I mean, is there any other chart that is, if you will, in a major either indice, currency, bond product? Is there any other chart that is phenomenal as the move in the dollar? Because I'm going to tell you right now, because I don't know of one, other than the fact that the dollar ripping like this just decimated some of the metals. I mean, the metals, I mean, this is suffrage right here. But again, you're looking at this like, oh, they're selling gold. It's like an arb relationship between the dollar again and gold. So the reason I wanted to bring up the dollar was not necessarily to discuss the metals. At this point, the metals are dead, right? Okay, it's to discuss the fact that the dollar, if this continues to rip to the upside, all right, it's still going to be an indication of fear. But the trade itself is almost like self-fulfilling. The more you buy the dollar, the more you should be afraid at this point. With all the monetary policy and all the monetary stimulus that's been done out there, they've just flooded the world with US dollars, and yet the world is still buying it. Okay, that makes me afraid, and it should. All right. All right, onward and upward from there. So the Goldilocks marketplace is officially dead. The next thing we want to look at is a little bit about volatility. So, volatility hit this marketplace to a degree. Okay. But to me, it wasn't much of a shock. And when I say it wasn't much of a shock, like, all right, volatility kind of, earlier this week was down to the 15, 16 handle. It's shot. It's not even at 20. Like the VIX is still taking a dirt nap, in my opinion. And this is where, again, you see some sell side activity going on right now. And you're like, yeah, baby, the volatility's rocking. Compared to what? Compared to the fact that, again, if you look at the S&Ps and brought up the S&Ps, watch again. I'm going to go in the S&Ps and I'm going to go to the 30-day 1 hour. Why do I use that particular chart? I use that chart just to show you, like, hey, calm down there, cowboy. Don't get too excited. The inflection point, or should I say kind of the midpoint of trade of really almost the last 30 days, it's somewhere around like 42.11. Okay, 42.11 is a pretty pivotal point. Where are we right now? Again, we're down here at 41.60, some odd. It's not a humongous move. And again, I just want you to gather a little bit of perspective on that particular front that, the VIX kind of reacted mildly, again, in my opinion. The next thing I would look at over here is the volatility futures. What have the volatility futures done for you lately? Absolutely nothing. You look at the jump over here, but that jump is caused by the roll. But the volatility futures themselves, we're not anywhere near, okay, flipping over. And when I say flipping over, what we tend to look at in this respect is the volatility futures from front month to back month. And I'll just highlight them. Front month, back month is what I'm usually focused on, at least initially, right? So we'll look at, July and August. And the July volatility futures are down here at roughly 2070. Okay, then you come out to the August, and they're at like 21.77. Like, come on, people. All right, we haven't flipped over. That's when flipping over is when the short-term volatility future starts to exceed longer duration volatility, which ultimately means we're in it, baby. We're far from in it. And I just wanted to point that out because you're looking at this and you're saying to yourself like, "Oh man, this was a rocking week." Okay, and the S&Ps are they're just kind of like sinking into like a warm bath right now. All right, to the bottom of the screen. To the bottom of the screen over here, we're now going to bring up the VVIX. That's the volatility of the volatility index. Now, this is where you do have to be a little bit cautious. So a moment ago, I said, yeah, no, volatility barely did anything. And the marketplace just, sunk into like a warm bath. The VVIX, however, it's bid. Okay. And anytime that VVIX, I mean, anytime it's north of 110, which has been like for like the last, 14 months, anytime it's north of 110, you need to be on your game. But we're up here in like Never Neverland. We're up here like 130. Okay, that really starts to grab my attention, especially, okay, since the VVIX is it's indicative. Like today, it's still indicative. Traders are still hedging, and that just shocks me. Like they're still hedging over here. You've had a lot thrown at this marketplace, and the marketplace is down here, but traders are still hedging. And if they're still hedging, that to me is an indication still of prolonged volatility. So you have this idea of Goldilocks being dead, all right? The marketplace sooner or later is going to figure out this is it, baby. This is as good as it's going to get. In terms of like maybe the economy gets better, but that's detached from the marketplace, okay? The marketplace loves Fed, it loves free money, it loves, okay, low interest rates. All of that, all right, again, it's as good as it's going to get. It doesn't mean that the marketplace is going to collapse and, it's going to say, that's it, man, it's all over, okay? It's not necessarily over, but it is passe, meaning that there's not that much more stimulus coming down the pipe, okay? It doesn't matter what happens because the Fed is not going to be, again, as accommodative, which also points to, I believe that traders are on this already, and they're already looking at things like out of the money puts, and that's one of the reasons that SKEW is so high. If you've never looked at SKEW before, well, welcome to SKEW. SKEW is the out-of-the-money puts versus the out-of-the-money calls specific to the SPX. SKEW this week hit its highest levels ever. All right, so I even mentioned that last week because last week SKEW hit its highest levels ever. But this week, no, there's more. It was all the way in the 160, 161 print. SKEW is actually calculated to the end of the day. I would believe, okay, coming into this weekend, that SKEW will drop a little bit, but it's neither here nor there. Okay, listen, the out of the money index puts are still being bought like there's no tomorrow. And because of that, it is still allowing us, right, to sell premium quite readily. And when I'm talking about selling premium and so forth, okay, some of the trades that I've gone out and done, here's a little bit of a funky, it's like a Christmas tree trade where I went out in the spiders and bought a 420 put and then laddered and sold 362 puts, 339 puts, 290 puts against it. And this particular trade, if you look at like a risk graph of it, okay, it's if the marketplace rallies, the trade makes just under $1,000. But if the marketplace sells off hard, you can make as much as about 6,000 or 7,000. There are some naked back month units in here, which you could overcome that if you used options on futures and overcome what? The margin. The margin is quite considerable in a trade like this, but it's the old-fashioned Christmas tree trade. I haven't pulled that one out of the bag of tricks in quite some years, but listen, the SKEW, it's ready for it. I mean, that is where this trade is at. Last but definitely not least that I want to cover it. Again, I can't reiterate enough, like premium selling, that's just where it's at right now. I mean, you just have not ever had a better SKEW. And you can say that quite literally. You're looking at a 161 SKEW. You want to sell premium, it's there. It's just like at this point in time, take a look at the marketplace for just a second. At this point in time, the only thing that really makes me a little bit more reserved about selling premium is the fact that, we could come off big. The marketplace starts to realize, again, and if the marketplace starts to realize that this is it, baby, this is as good as it gets, all right, you're going to have a fairly precipitous drop inside of the marketplace. Where that ends, nobody knows. So although you want to sell premium, you want to be constrained. You want to see volatility pick its head up off the mat. And again, a VIX, and you can see the VIX is actually taking off here into the close. Check this out. There's 2 minutes to go to the cash close here. Again, we're into this quadruple kind of witching. That's not really creating any more volatility, but vol is starting to pick up on a Friday afternoon, which is unusual unto itself. And there's some sell side activity really starting to kind of kick in. I'll go over to the Nasdaq here momentarily. This right now, I'm telling you, the Nasdaq, people, that is the object of my affection. I am less worried about individual stocks. Like, who cares about individual stocks? Okay, when the correlation coefficient is so high. I mean, listen, everything is correlated right now. It doesn't matter about individual stocks. It's all about sectors and sector rotations. And NASDAQ, they're coming for you. Okay, last thing I always mention, okay, on these weekend updates is about expected move. This particular trading week, the week that we're in right now, that's ending literally in 90 seconds here, has all been about expected move. Where are we right now? Okay, we are just coming underneath the edge of the expected move. Now, we have a week that we just passed through where the expected move was plus or minus $59. Where are we right now? Just outside the expected move. But the reason I'm bringing this up, okay, is this entire trading day has been nothing more than bouncing to the edge of the expected move to the penny. All I did is just zoomed in, okay, to an intraday 1 day, 1 minute chart to kind of delineate. Again, here comes the sellers right now. This marketplace cannot close fast enough. I just wanted to kind of delineate, if you will, the entire trading session is coming into the edge of the expected move. And now what you're getting is gamma risk is rearing its ugly head, and they are crushing this thing into the close and bringing the NASDAQ as close to the 14,000 level as it can possibly get. All right, with that, what are we expecting for next week? Okay, probably one of the most important aspects of understanding the expected move is that, again, it is forward looking. And here we are into today's closing bell. That marketplace could not have closed soon enough. Next week, okay, and this is not settled yet. Again, the SPX, all right, that settlement is not going to occur, meaning that, you know, the final expected move isn't really out until about 15 minutes after. Therefore, okay, we're sitting right now somewhere about an $86 expected move. Again, kind of compare and contrast, right? We just came off of a week with a $59 expected move. Now we're actually going to move into a week with close to an $86 expected move. Put your helmet on, people. All right, we're going in. There's going to be more volatility. As I said, what happened this week, it's kind of lackluster. You know, the marketplace, though, is just starting to figure it out. It's going to be all about the dollar. It's going to be all about correlation coefficients. But moreover, like if you're looking for anything to confirm, all right, moves in this marketplace, look no further than the NASDAQ, because when you have other sectors that have been so badly damaged, okay, but the S&Ps are still rather what? Unscathed, you then have to look at the sector that's the strongest, and it's unequivocally tech. Tech is going to possibly be served up to you on a platter next week. Watch for it. Watch for market volatility. And again, dollar strength. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.